Listen up, business comrades. Gather round because what we're about to discuss could make or break your business. Today, we're diving into the thrilling world of inventory accounting. Now, I know what you're thinking. Inventory accounting? Thrilling? Really? Yes, I know, it sounds about as exciting as watching paint dry. But bear with me, because understanding this can be a game changer. But trust me, this stuff matters. It's not just about numbers and spreadsheets, it's about the very foundation of your business operations. Why? Because inventory, my friends, is money. Every item on your shelf represents potential revenue, and mismanaging it can lead to financial disaster. It's the lifeblood of many businesses, and keeping track of it is essential to staying afloat in this capitalist ocean we call life. Imagine trying to navigate without a map. Inventory accounting is that map. Think of it like this. You wouldn't throw a rager and just assume how much booze you have left, right? You'd plan, you'd count, you'd make sure you have enough to keep the party going. You'd take stock, count those precious bottles, and maybe shed a tear for the fallen comrades. The same meticulous care should be applied to your business inventory. Inventory accounting is the same idea, but instead of empty beer cans, we're talking about the actual stuff your business relies on. Every product, every item is a piece of your business puzzle. Ignore it at your peril. Neglecting inventory management can lead to stockouts, overstock, and ultimately lost revenue. So take it seriously, and your business will thank you. Before we get our hands dirty, let's decode some jargon. Understanding these terms is crucial for navigating the complex world of inventory accounting. Inventory accounting, like any good bureaucracy, has its own special language. First up, beginning inventory. This is the inventory you have on hand at the start of a period, like a fresh start. Imagine it as the initial stockpile you have before any sales or purchases occur. This is your starting point, the inventory you have on hand at the beginning of a period, like a fresh start. It's the foundation upon which all your inventory management for the period will be built. Then there's ending inventory, which is what's left over at the end. This is the inventory that remains unsold at the end of the period. It's like the leftovers after a big meal, but hopefully more appealing and valuable. Think of it like leftovers, but hopefully more appealing. Ending inventory is crucial for calculating your business's profitability and for planning future inventory needs. Next, we have COGS, or cost of goods sold. This is the total cost of making or acquiring the stuff you sold. It's a key figure in determining your gross profit. This is the total cost of making or acquiring the stuff you sold. Think of it as the cost of ingredients for a batch of cookies, except less delicious and more about spreadsheets. It includes all the costs directly tied to the production of goods. It's like calculating the cost of ingredients for a batch of cookies, except less delicious and more about spreadsheets. This figure helps you understand how much it costs to produce your goods and is essential for pricing strategies. And let's not forget shrinkage. This term refers to inventory losses from theft, damage, or just plain disappearing acts. It's an unfortunate reality in inventory management. No, not the kind that happens in cold water. Shrinkage can significantly impact your bottom line if not properly managed. This refers to inventory losses from theft, damage, or just plain disappearing acts. It's like the Bermuda Triangle of your stockroom, where items mysteriously vanish. It's the Bermuda Triangle of your stockroom. Managing shrinkage involves implementing security measures and regular inventory audits to minimize losses. Finally, write-offs are like giving up on those lost items and removing them from your books. Sad, but sometimes necessary. Write-offs help you maintain accurate financial records by acknowledging that some inventory is no longer usable or sellable. Understanding these terms and how they impact your business is essential for effective inventory management. By keeping a close eye on your inventory, you can make informed decisions that drive profitability and growth. Now let's talk systems, baby. There are two main ways to track inventory: periodic and perpetual. Periodic inventory is like taking a casual stroll through your stockroom every now and then. You do a manual count, update your records, and call it a day. It's simple, but not exactly real-time information. Perpetual inventory, on the other hand, is like having a surveillance system in your warehouse. Every movement is tracked in real time, giving you a constant pulse on your inventory levels. It's more work, but it's also more accurate and gives you better control. Remember those disappearing acts we talked about? You know, the ones where your inventory seems to vanish into thin air? Those are stock discrepancies, my friends. They can be quite the headache for any business. It's when your records say you have 100 widgets, but in reality there are only 97. It's like a magic trick gone wrong. Where did those 3 widgets go? Did they just vanish into thin air? Maybe they sprouted legs and ran off to join the circus. Or perhaps they decided to take a vacation without telling anyone. Or maybe it's something more mundane, like theft, damage, or misplacement. Sometimes it's just a simple case of items being stored in the wrong place, or just plain old human error. Mistakes happen after all. A wrong entry here, a missed count there. This is where stock taking, or physically counting your inventory, comes in. It's a crucial step in ensuring accuracy. It's like a roll call for your products, ensuring everyone's accounted for. Every item gets its moment of recognition, and when things don't add up, it's time for reconciliation. This is where the real detective work begins. This is where you play detective, diving deep into the records and data. Figure out the cause of the discrepancy. Was it a counting error, a misplaced item, or something more sinister? And adjust your records accordingly. It's all about ensuring that your inventory reflects reality, keeping everything in balance. Section 5. FIFO, LIFO, weighted average, choosing your inventory weapon. Now let's talk about how we value this inventory. Because, surprise, surprise, not all inventory is created equal. We have 3 main methods: FIFO, LIFO, and weighted average. Think of these methods as different weapons in your inventory arsenal. Each has its pros and cons, and choosing the right one can have a real impact on your bottom line, taxes, and ability to buy those yacht-shaped swimming pools you've been eyeing. Section 6. FIFO. First in, first out, because someone has to be first. First up is FIFO, or first in, first out. It's the inventory equivalent of a queue at a British bank. The oldest inventory gets sold first, and its cost is used to calculate COGS. It's logical, easy to understand, and generally reflects the actual flow of goods. In times of rising prices, inflation, FIFO can inflate your profits on paper, potentially leading to a higher tax bill. Section 7. LIFO, last in, first out. The fashionable inventory method. Next we have LIFO, or last in, first out. This method is all about being trendy. It assumes you're selling the newest inventory first, even if it means reaching to the back of the stockroom. During inflation, LIFO can result in lower taxable income, which is always nice. It's less common, can be more complex, and might not accurately reflect the actual flow of goods. Plus, it's not allowed in some countries. Those rule followers. Section 8. Weighted average. The level-headed inventory approach. Finally, we have weighted average, the level-headed pragmatist of the group. This method calculates the average cost of all your inventory and applies it to each sale. It's simple, smooths out price fluctuations, and provides a good middle ground between FIFO and LIFO. It doesn't reflect the actual cost of individual items, and it can be less accurate if your inventory costs fluctuate wildly. Section 9. Accounting software and inventory systems, a match made in heaven? Now imagine trying to manage all this manually. The spreadsheets, the calculations, the existential dread. Thankfully, we live in an age of technological marvels. Integrating your accounting software with your inventory system is like having a personal assistant for your inventory. No more manual data entry, reduced errors, and real-time updates on your inventory levels. It's a beautiful symphony of efficiency, leaving you free to focus on more important things, like finally figuring out what a blockchain is. Section 10. Inventory journal. Entries, not as scary as they sound. Yes, we're talking about those pesky journal entries. They're the bread and butter of accounting, and inventory accounting is no exception. But fear not, they're not as scary as they sound. Essentially, every inventory transaction, whether it's buying, selling, or adjusting, needs to be recorded in your accounting ledger. It's like keeping a diary for your inventory, documenting every twist and turn of its journey. Section 11. Inventory accounting best practices, level up your business. Congratulations, you made it. You're now well-versed in the thrilling world of inventory accounting. But before you run off to celebrate with a celebratory spreadsheet, let's leave you with some best practices. FIFO, LIFO, or weighted average. Pick your poison carefully. Real-time tracking is your friend. Know your costs, like a hawk eyeing its prey. Let software do the heavy lifting so you don't have to. Follow these tips and you'll be well on your way to inventory accounting mastery. Now go forth and conquer those spreadsheets.